In today's video, I'm gonna share my go-to smart money strategies set up I trade every day for the past 2 years. This day trading system is designed to be simple yet effective. It involves using 2 timeframes, the 30-minute chart and the 5-minute one. Location, context, and market structure are key components. Here are the step-by-step instructions. You start by analyzing the 30-minute chart. You look for the direction of the market structure, which indicates whether the price is currently bullish or bearish. You aim to trade in the same direction as the order flow, as it provides a general market bias. Trending markets are simply markets that are continuing to break in one direction, either creating bullish or bearish market structure. These markets are characterized by 2 important moves, the impulsive move and the retracement one. It's a basic step, but you should be able to identify these moves almost immediately. Otherwise, you will not be able to make the correct decisions. An impulsive move is one where the market moves strongly or heavily in one direction, covering a great distance in a short period of time. Bullish market structure is defined by a market that is trending up and is creating higher lows and higher highs. It typically has impulsive up moves and corrective pullbacks. Bearish market structure is defined by a market that is trending down and is creating lower highs and lower lows. It typically has impulsive down moves and corrective pullbacks. These corrections form against the trend and they should not be traded. You need to know when the corrective moves end and when an impulsive move begins. Your plan is to anticipate the end of the corrective moves and the beginning of new impulsive moves by using supply and demand areas. The next step is to find major supply or demand areas near the most recent price action, or if you're an ICT student, you look for order blocks. So a bullish trend is identified by a series of movements where the high points exceed previous highs. Once identified, your goal will be to find entry points in demand zones when the market is underpriced. In these zones, buyers add to their positions and create an imbalance, moving the price higher. A bearish trend is confirmed when there are lower lows and lower highs, and is characterized by a series of movements where the low points break the previous lows. Once determined, your goal will be to find entry points in lower highs to sell in supply zones when the market is overpriced. In those zones, sellers add to their positions and create an imbalance, moving the price lower. So supply zones represent sellers, while demand zones represent buyers. In an area of demand, there is increased buying pressure and the price is expected to rise. And in an area of supply, there is increased selling pressure and the price is expected to decrease. The idea is to find areas on the chart where demand overcame supply in an uptrend for long trades, or where supply overcame demand in a downtrend for short trades. And this is how you draw these zones. For a supply zone, search the last bullish candle before an important price drop and mark the extremes of the candle. For a demand zone, look for the most recent candle before an important up move. As a supply or demand trader, you will be paying very close attention to the bigger picture trend and both the strength of the imbalances and where in the overall trend these new imbalances are being created. There are 2 types of supply and demand zones, trend continuing zones and reversal ones. You will mainly look for trend continuing patterns of supply and demand. These are formed within the trend. When the market is moving in an uptrend, price consolidates for a certain period of time, forms the base, and then starts to rise upwards again, where it creates an area of demand. So an uptrend requires a rally, followed by a base, followed by another rally. A long position should be entered when the price comes to mitigate or revisit this area. In a downtrend, you aim to trade when the price falls and consolidates, creating a base, and further breaks down and creates a supply zone. A short position is targeted when the price comes to mitigate this area. In this continuation pattern, the market doesn't retrace much. It pauses and enters in a minor accumulation or distribution phase before moving strongly in the same direction. The third step is to wait for the price to retrace and touch one of your supply or demand zones. Once the price touches the zone, you move to the 5-minute chart. Here's an important point. The strength of the impulse move on the higher time frame is important when you're looking at these imbalances. It's a key characteristic that can give you useful information, but it's not the only aspect you need to consider. Sometimes, even when you see a very strong imbalance, when one side, buyers or sellers, is dominating the market doesn't always react at these supply or demand zones as you would expect. It's like the imbalance is completely ignored and disappears without any significant impact. That's why understanding the context of the market you're trading in can have a big impact on your results. Focus on markets where momentum is strong and has significant price movements, the impulses we've talked before. These markets tend to offer better trading opportunities. And the reason we moved to a lower time frame was to find other factors of confluence. When there is confluence, it means that multiple factors are pointing towards the same conclusion, reinforcing the significance of that particular area in the market. The more technical tools or signals that validate a price move or confirm the importance of a specific price level, the stronger that level becomes. I mainly use 3 factors of confluence: the ultra-high volume candle, the daily VWAP rejection, and the change of character. These confluence factors add a layer of confirmation and increase the confidence in a trade setup. Number 4 is to trade only during the London or the New York sessions, if you're trading Forex, indices, or crypto. If you're trading stocks, you trade of course during the New York session. This is an important filter. The London and the New York sessions are known for their high trading volume and liquidity. Higher liquidity means there are more participants in the market. These sessions often experience increased market volatility compared to other sessions. Volatility refers to the magnitude of price fluctuations within a period, and the higher volatility can present more trading opportunities, as prices tend to move more rapidly, providing potential profit opportunities. Let's talk about the first confluence factor, which is a high volume candle or an ultra-high volume candle. I look for beam bars and engulfing bars to reveal market rejection. This is yen futures on the 30-minute time frame. As you can see, the market was trending down, making lower lows and lower highs. As the trend is down, we need to find a supply zone. I spot this possible drop-base drop continuation pattern right here. And now we move on to the 5-minute time frame. Market returned to test the zone during the London session, so this checks another condition. Now we look for high volume candles to find the short entry. I see this candle with a wick on top of it, almost a beam bar, having high volume. This is the VSA condition checked, our factor of confluence indicating the selling pressure, the green light to go short. Stop loss above the supply zone, and to take profit at the next major demand zones in the market structure. I like to take partial profits as the market moves in my direction. Same market, price makes higher highs and higher lows, so we must find a demand zone. I spot this potential base rally demand zone right here. Let me quickly explain how these zones are created. You need to understand this process. Before the first rally, we had bank traders placing trades in the consolidation area. They consume all of the buy orders coming from retail traders. The consumption of buy orders means the market makes a small move lower, and this creates the base, which the demand zone eventually forms off. The move lower causes a large number of retail traders who went long on the rally higher to close their trades at a loss, which puts a lot of sell orders into the market. In addition to this, there will be a small number of retail traders who will think the move down is a trend reversal, meaning they will place sell trades with the expectation that the market is going to move lower. With 2 sets of retail traders placing sell orders, the banks begin buying again, knowing they will make the market move higher. and in the process cause anybody who sold on the move lower to close their trades at a loss, which ends up being the bank traders' profits. And during the buying process, the banks may not find enough sellers and they can't buy all the orders. So they will leave significant limit orders around the same level, which is a demand zone. And when the market returns to test it, prices will be rejected. Now let's go to the 5-minute time frame for the VSA condition. First, price returned to our zone during the London session. I see two potential trades. First one is this pin bar on ultra high volume, and the second one is this large engulfing candle on high volume. Both of these candles were valid buy signals. With screen time and practice, you will notice that when the market tests the zone, there are two possibilities. Either price goes strongly up because the orders left in the zone are enough to push the market up, or the market will still need time to accumulate enough orders, so we can see a few candles that form an accumulation phase before the strong up move. Stop loss below the demand zone and take profit at the next major supply zones in the market structure. One more example, British pound futures, 30-minute time frame. The price is making lower lows and lower highs, so we must find a supply zone. We are in a corrective phase. The market was trending up, forming a small rally. It was followed by a very small consolidation, or a base, and then a very strong move down. This rally base drop supply zone represents a footprint of financial institutions that sold the price from that level. So you follow the footprint and do what the big boys are doing. Let's find the VSA condition on the 5-minute time frame. And as you can see, the market returned to test the supply zone, but during the Tokyo session, when you encounter situations like this, it's better to wait for the London Open and then find your entry. This is important. Don't take trades outside the main market hours. Prices were initially rejected, but the market didn't go down strongly. Here's the entry trigger, right at the London Open. An engulfing candle with an ultra high volume. Stop loss goes above this area, or if you want to be conservative, above the supply zone, and take profit at the next major demand zone, somewhere around here. Daily VWAP rejection is another confluence factor you could look for. VWAP represents an important price level, especially in day trading, because it serves as a reference point or benchmark. I said it before, when banks execute large orders, they aim to minimize the impact on the market by executing the orders gradually over a period of time. The VWAP is used as a benchmark price for this execution period. To achieve an average price that is equal to or better than VWAP, banks place buy or sell orders based on the price relative to the VWAP. On a day when the market is trending upward, these algorithms will issue buy orders when the price drops below the VWAP. This allows them to take advantage of prices that are below the average, potentially getting a better deal. On a day when the market is trending downward, the same algorithms will issue sell orders when the price breaks above the view-up. This enables them to capitalize on prices that are above the average, potentially maximizing their profits. So how can we, as retail traders, take advantage of this? Most retail traders wait for price to cross the main view-up line before entering a position. And that's a valid strategy. I've used it a lot in my trading. But the problem is that you are entering very late. Often, a big part of the move already took place, and you're joining the party too late. And that's why lately I've started taking trades at the view-up bands. View-up bands are lines above and below the view-up line, projected with multiples of the standard deviation. I now plot the first and the second set of bands, and I try to take my trades in the area between them. Just look at the difference between these two potential buy positions, one at the first view-up band, and the other one when price crossed the main view-up line. This distance is significant. This can and will make the difference between a good trade with a proper risk-to-reward ratio and one delayed entry with a poor trade management. We are trading Euro futures. Price is making lower lows and lower highs. We are in a downtrend, so we must find supply areas. And here's a rally-based drop supply zone. Sometimes the base or the consolidation is not necessarily formed by multiple candles. As you can see in this example, the market moved up, formed a pin bar, and then moved down strongly. So the base was formed only by one candle. And this happens frequently in the market. If you find patterns like this, where the market rallies and drops surprisingly, these setups are still considered as rally-based drop zones. Now we move to the lower time frame to find the view-up confluence. I have removed the main view-up line, and I kept only the bands. Look at what happened when the market returned to test the zone. As you can see, the market stopped moving up, but before the London session, we even had a VSA confirmation with this engulfing candle on high volume. Observe how the view-up bands are offering dynamic resistance right at the supply zone. When this happens, I wait for a pin bar or an engulfing bar to form in this area. Stop loss above the supply zone, and take profit at the next demand zones in the price structure. Another trade. I see an upward trend, higher highs and higher lows. In a strong trending market like this one, look for a continuation pattern that is composed of a rally-based rally, a move up followed by a pause, and then another move up. And here it is, the demand zone we've been searching for. The base was not quite a retracement. There was only a small pause before another move up. Now it's time to find the actual entry point on the 5-minute time frame. First, the retracement happened during the London session, so we're good to go if we can find a trigger. When price retraces to test this zone, we hope for rejection, expecting more buy orders from the banks in this zone. And look at the power of the view-up bands. Price stopped right in the area between the first and the second view-up band, which also aligns with the demand zone. The conservative entry is after you find a pin bar or an engulfing candle. But it's not wrong if you pull the trigger inside this area. I'm conservative and I like a candle confirmation as an extra confluence. Stop loss goes below the demand zone and take profit at the next supply zones. Another entry, and maybe the most conservative and the most delayed one, is after a break of market structure on lower timeframes. A change of character if you're an ICT student. In simple terms, the first time a lower high or a higher low is removed from a chart is known as a chalk. A change of character marks an initial shift in the order flow that can sometimes signal a short or even long-term price reversal. So this pattern is generally considered a reversal one, as we're seeing prices break internal structure, where a minor level of supply or demand zone fails. A change of character should really only be used as a confluence factor and shouldn't be something you rely on solely for getting market direction. Use it as a confirmation on the lower timeframes. We are analyzing Euro futures, a 30-minute timeframe. So price is making higher swing highs and higher swing lows. The plan is to find a demand zone and trade the chalk on a lower timeframe. Here's a bonus tip to find the best demand zones. It's a good sign if you see successive large bullish candles at the beginning of the demand zone. Sometimes a bullish move can come from just one single large candle. Other times, there are a few candles appearing one after another. But when you see this on your charts, it's a clear sign of bullish pressure. We move to a lower time frame to find the change of character. In this case, we can observe a shift in market behavior from bearish to bullish on the 5-minute time frame. Initially, there was a bearish structure, but this changed when the last point of supply failed. And of course, this chalk came as a reaction from our higher time frame demand zone. Look at what happened when the market retraced back to test the demand zone. A clear rejection. The concept here is that if price was truly going to continue in a bearish direction, it would have respected the last zone of supply and continued to break through any demand levels created during the pullback. However, in this case, the price failed to do so, indicating a potential shift in momentum. And another point to consider, the chalk happened outside our trading hours, but very close to London session. Again, please don't rush and try to be patient and wait to take your trade during the active market hours. You can proceed with your entry in two ways. You can enter right after the chalk appears on the lower time frame, and this is the risky approach. There is a risk that price may just be sweeping the zone before continuing in the same direction as the previous established trend. And this presents a danger for traders who solely rely on chalks, as they can produce quite a few false signals. To increase the accuracy of identifying high probability chalks, you might want to use additional confluences. And this is the second entry method. You find another lower time frame demand zone because you want to buy, and take your trade from that area if the price returns to it. This is the conservative entry. In our case, price indeed retraced to this 5-minute demand zone at the beginning of the London session. Keep in mind that if the market has momentum, you may not get the chance for an entry after the change of character. Once you've identified a good quality supply or demand zone to trade, and in which you are expecting a reaction from, you can step down to the 5-minute time frame and search for entries by looking for a change of character. Keep in mind that sometimes looking for a chalk on the 5-minute time frame may not be enough to justify placing a trade. So leave the volume indicator on your charts or the VWAP, and when things are unclear, you can consult these tools to make a decision. We are looking at the futures market of Aussie dollar, obvious uptrend, a bullish market characterized by rising prices with many impulsive up moves and smaller corrective pullbacks. I spot a continuation pattern that forms in this uptrend, a rally-based rally demand zone. This means a move up followed by a short accumulation phase, followed by another move up. As usual, the plan is to go to a lower time frame. When price retraces to test this zone, we expect to see a rejection, hoping for more buy orders from the banks in this zone. In this time frame, we can observe a shift in price action from bearish to bullish. Initially, there was a break of structure, but it turned out to be nothing more than a liquidity run, taking stops below the zone. Price then broke above the last swing high and confirmed the change of character. This is a textbook shift in the order flow to the upside, one that previously had a liquidity run. The demand rejection happened during the Tokyo session, and the chalk happened right at the beginning of the London session. This is another sign that you're trading on the correct side of the market. It's always nice to see immediate volatility and market reaction when you're entering. Again, you can proceed with your entry in two ways. The risky approach, right after the chalk appears on the lower time frame, with the risk that price may just be sweeping the zone before continuing in the downward direction. Or you wait for price to retrace to a recent demand zone formed prior to the change of character, the conservative entry. In this particular example, the retracement never came. Market had momentum at the beginning of the session, and if you didn't enter after the chalk, you didn't get the second chance for an entry.